What's up, everybody? This is Misael Gonzalez. You're watching Wall Street Saturday, a show about God, investing, and stocks. Our show is for educational purposes only. We're not financial advisors. So go ahead and enjoy the show. Share it, like, subscribe, and hit the notification bell to be notified every time a new video comes out. Thank you.
Hello, everyone, and welcome back to Wall Street Saturday. We've got a really special episode for you today. We're going to be talking about inflation, the inverted yield curve, oil, and the quarter in review, since we've had one of the worst quarters in the past 2 years. But before we get into all that, I am Joshua Trusty.
Misael Gonzalez.
And I'm Josh Florez. We just want to thank you guys again for tuning into another video. As Josh had mentioned, it is April 2nd. And before we get too far into this, I want to pray us in here. Dear Heavenly Father, just thank you for another Saturday. Thank you for another time that we get to come together and share some of the things that you are moving in this world, and help us have eyes to see what you are doing and the wisdom to navigate those. And we thank you, Lord, just for today. And lastly, please help the Jayhawks beat Nova today in the Final Four. And it's in your holy name we pray. Amen. Yeah,
probably lost a few Nova fans with that last part of the prayer, but we'll continue on anyway.
You know, man, they have every right to pray too, you know. But
true.
But yeah, man, just a little bit of fun before there. Of course, I have my Jayhawk shirt on because they do get to play Nova, a repeat of the 2018 Final Four. But that's not what this video is about. But you know, any chance that I get to use the creator of the world to advance my Jayhawks, I definitely try to do that. But yeah, so one of the things that we got to talk about today is, and I'll share it right here, there's no fancy charts or anything like that, but we have our quarterly ends. Of course, January 3rd was the first trading day of 2022. And of course, we have March 31st, which was the close of the first quarter of the year. So of course, we're a little bit in the red. You can see the S&P was down 5%, the NASDAQ's down, excuse me, did I say that backwards? The S&P is down 5%, NASDAQ's down 9%, almost 10. And of course, the Dow is 4%. Dow typically being like pretty, how should I say, not so volatile, I guess is what I'm trying to say. Industrials are typically not too crazy, not like technology, which can tend to lean a little bit more on the speculative side. But other things that were kind of going on, we wanted to talk a little bit about the oil and gas. And of course, we got to talk about this inverted yield curve. And I was going to pass it on to Josh because he's been really following this oil and gas here. And we have some thoughts. I have GUSH going, he has ET. So what were you thinking, Josh, with that oil?
You know, for me, I've really been pleased with the oil and gas narrative that's been going on in terms of the performance of some of the different stocks that I've been investing in. Like you mentioned before, I do have a position in energy transfer, which I've had for over a year. So I definitely am going to get long-term capital gains tax on that one. But it's performed quite well. Before the Russia-Ukraine conflict, I was around 40%. Had 40% gains. Then after that, it got boosted to about 60% gains. And if I were to look at the chart real quick, right now it's around $11.52, and over the past month, it's gone up by almost 10%. So it's gone up by about 9.82%. And then PSCE, which so the energy transfer is just one particular stock. It's not an ETF, but something like PSCE, which is basically small cap energy. That's the Invesco S&P small cap energy ETF. That one has gone up by over 13% in the past month. Year to date, it's gone up by about 40%. So, you know, the stock market generally tends to give you about 10 to 15% gain, performance every year. So this is pretty substantial in terms of how well the ET, the stock, and then PSCE, the ETF, have been performing. But I would say that one thing that I'm thinking about right now when it comes to the oil and gas play is just when to cut back and when to just take some profit. So I'm beginning to take some profit just because there's just been such an incredible run up over the past 3 months, over the past quarter. So I'm thinking about when to complete this exit, because as we said before, and I was talking about this with Misael offline, which is that the oil and gas play that we've been talking about was never meant to be something that's ultra long term for the purposes of our discussion here. It's mainly predicated upon the Russia-Ukraine conflict. So that narrative has been really pushing up with those different oil and gas plays. And there was one thing I did want to mention with regard to that, and like how oil and gas prices might be fluctuating. Let me share really quickly. There is an article by Edward Jones which talks about how the oil and gas prices could be changing over time. So if you can see my screen here, Edward Jones is predicting that there's roughly a 70% chance, so that's this category here, plus this category here, that oil prices for West Texas crude, which is like the WCI here, are going to be above $100 per barrel. And there's only like a 30% chance that they're going to go below $100 per barrel. So that's a good sign for oil prices. And right now we're roughly at $99.42. So in general, I think like oil prices are going to either like stabilize or go up. But still, if you were to look at, say, something like PSCE long term, you would see something like that they're overall in the past like 5 years, they haven't been doing so well. So those are like two different competing effects. One is so that the more recent oil and gas narrative predicated upon like the Russia-Ukraine conflict is profitable. That's just a fact. Looking at the year-to-date profitability of something like PSCE, but overall, in like the longer term, maybe 5 years, and looking more, the profitability of some of these ETFs in just the general oil and gas industry is kind of questionable, because you have like all of different pressures which are going on, like ESGs or like or even specific companies that can name drop like Tesla, which would reduce the demand for oil and gas. So I don't think they're going away anytime soon, but long term, I do want to be moving out of these positions. So that's where I'm at currently with like the oil and gas play. So I do want to make sure that I am moving towards the future of like where money is going. I want to be like where the money is going to be before it's there. So yeah, that's where I'm at right now with oil and gas play.
Yeah, I can definitely share those thoughts with you. I as you were kind of speaking, I wrote down 3 things that I can recall this week alone. Some bear, some bull. So I think that there's 2 bears here that I was kind of seeing, and that is that obviously Biden has some feelings about this oil and gas stuff, right? Like how we had seen that he was releasing like 100 barrels of oil a day, and I know that wasn't necessarily supposed to like have like a material impact on our experiences at the gas pumps, but it is obviously like on their agenda if we're letting go of our reserves. The other thing too, of course, this is like no surprise, but obviously the fight against inflation has begun with the Federal Reserve raising their interest rates. So I mean, again, the whole point for me when I first got into oil and gas was because I was trying to fight inflation, which is obviously like a good thing. But I do expect to see a more aggressive or hawkish is what they like to say around the CNBCs and Yahoo Finance, live TV, whatever. There is a pretty aggressive fight going on there to kind of reduce that, and so looking for an exit is not a bad idea. The only other thing that I can think of as a bull case is that I know that there are some countries still out there, mostly kind of like in the Asia, maybe some in Europe, that are struggling to get oil and gas, and so that's the demand for it is still pretty high to date, but as you were kind of mentioning, 20, 30 years from now, not necessarily. So definitely just got to kind of take a look on that. This isn't a cryptocurrency call or talk right now, but that might have something to do with the oil and gas too. Is just keep an eye on those cryptocurrencies as Russia's sanctions continue to increase or to build up against them. And so one of the things too that I wanted to kind of jump into that's a little bit of a little bit of an indicator of why things are kind of going crazy, and kind of the meat and bulk of our conversation is this inverted yield curve that has become a crazy hot topic over just the past couple of days. And so I wanted to share this article with you guys. I'm not sure, can you guys see that? But this
Yep,
is
I can see it.
yeah, perfect. So this is an article from the Wall Street Journal, and this guy, his name is John Hilsenrath. You know, he had a very, very, very good article. They have some great writers over there. You got to give it to the Wall Street Journal, but they have some great writers over there that have some really good content, and this kind of explains about what's going on here. And so, typically, what happens in this situation is that they're saying that it has quote unquote predicted every recession ever, right? And again, I kind of say that, I mean, like, although like that's the case, it doesn't mean that it doesn't mean that just because this happens there's going to be a recession. This just kind of happens to go hand in hand with all the recessions that have kind of happened in the past. But basically what it means is that the 2-year treasury return is higher than what a 10-year treasury return is. And you can kind of see that kind of explained right here. On a 2-year and 10-year treasury notes, on Friday, the yield for a 2-year treasury note hit 2.44, and on a 10-year note, it lagged 2.38. And so what I'm kind of getting out of this is that the demand for money right now, within 2 years, the demand for money is higher than what the demand for money in 10 years will be. And so those who invest in bonds, like if you're looking to get into bonds today, obviously the better bet would be to get a 2-year bond. What this also kind of says is that the investor sentiment is pretty low. And that's kind of the big hits that I wanted to say about that. I'm sure that you guys have some also things that you want to bring up about that. Misael, Josh, did you guys have any other thoughts into that?
Yeah, I would say that it's really counterintuitive to see the yield curve invert, mainly because, like you were there are two ways of looking at it at the very least. Like the first, like you already hit on, which was that the demand for money in the short term is greater than the demand for money in the long term. And the other way of looking at it, I think, is that there's more risk that is being compensated for in the short term than there's in the long term. So basically, if you're going to, as a pure example, suppose like you are going to get 3% for maybe like a 2-year loan that you make out to somebody else. So you're going to loan them money, and they're going to pay you like let's say 3% every year for those 2 years. Now, in this case, let's say that there's also, you can lend someone money for the next 20 years, and now they're only going to be paying you 2% per year. I mean, it would make more sense for you to be lending money on like a 2-year basis for maturity. So in that case, it just means that it implies that there's more risk for the short term than there is in the long term, which is counterintuitive, because the longer you're lending out money, the more chance there is of something going wrong. So people could fall in hard times, or a recession could happen in the next 20 years. In general, the longer your time frame you're looking at, the more risk there is. But in this case, it seems like the market's saying that there's a lot of risk occurring over the next 2 years, in the short term versus the longer term, which is concerning. Misael, did you want to chime in there?
Yeah, no, I think that's a good point that you brought up with the SPR, Strategic Petroleum Reserve. Interesting fact, those reserves are located along the Gulf Coast of Texas and Louisiana, so that's really close to home. And the total allowed or mandated storage capacity is 714 million barrels, so almost a bit, short of 1 million barrels for sure. So yeah, I think what was explicitly stated by the administration was that they were going to be releasing a certain amount of millions of barrels for about 6 months, which is the time that it would take the U.S. oil producers to kind of ramp up again after that huge kind of discouragement from prices during the pandemic. A lot of those small operators went out of business, and a lot of those operators just shut down those operations because we got to think about fracking. I mean, fracking is possible, but it's expensive and it's very, it takes time. So the moment prices started going down, then they were immediately discouraged to keep producing. So I think it's like to go along those lines, Joshua, Trusty. I think this play was meant to be a short-term play in terms of oil, because we know that eventually the price of oil would stabilize. So hopefully we can see that here in the next few months. But something interesting to keep in mind.
No, yeah, I wanted to say too, man, it's not all bad. You know, we had a good jobs report over this week too, so very, very thankful that we had some good news out of that. But the last thing that I kind of wanted to bring up and kind of share, and I'll bring up back up my spreadsheet, and just for those that are kind of thinking about what could they do today, what could they do right now, what can they think, and this is what happened over the quarter naturally. But if you're looking to get into it, I wanted to kind of illustrate what your play would be getting into these. So I know that Josh Trusty is really, really big into this NASDAQ. He loves TQQQ. You know, I mean, I love it too. It's one of my largest holdings. But also UPRO is one of my largest holdings too. And I know we talk a lot about those two there. But my portfolio personally reflects more of the S&P. And I'm like, some folks that I've talked to, there's reflects more of the NASDAQ. And of course, there's some that also reflect the Dow. But typically where I try to get to is like where I try to stay on is the S&P 500. And so those types of companies, I try to look for like blue chip, large companies that they're growth companies technically. Think like Apple and Microsoft, which are also tech companies as well. Those are also in the NASDAQ, but you know, they're large and they're slow growth, but they grow. You know, they're not as volatile and as risky. They don't have as high a betas as I would say to what they would be in the NASDAQ. And so those to me are typically home runs. But industrials are cool too. As we kind of look and think about this recession that's kind of heading, this might be a viable option for some if you're not looking to lose too much money. But until that moment comes, and I think that it's maybe around 11, 15 months or so to where we can actually hit like an official recession. I think the definition of a recession is not necessarily clear, right? It's pretty subjective, and you never really know you're in a recession until you're already in it. But until that moment comes, I think that we're still going to have a really good time. You can expect to go long and really do well during those times. So I just encourage you guys just to keep a hold on buying and purchasing. Again, don't go crazy. Do what makes you feel comfortable. If you're new to investing, I would wait until you know what you're doing before putting any money at risk. But I do expect maybe in about, hopefully next year, maybe 2 or 3 years, we're going to be having a much different conversation.
Yeah, I would agree. Like, even though the yield curve like is inverting and that does predict a recession, you know, it's not like the recession happens like a week after the yield curve inverts. It does take some time for that to sink into the economy and to have an effect. So no worries like immediately. You don't need to like just like suddenly change course with your portfolio. But yeah, that is something to look out for in the future. And to me at least, if you are like prudent in the way that you're investing, you know, not just like dumping a lot of money in it and all at one time, trying to time the market when there is a recession, when there is a downturn, that would be a good buying opportunity for you, so that you can just like basically get a lot of your favorite stocks at a nice discount. So whatever you do, don't just like to freak out because the yield curve has inverted. Stay the course, stay in your stocks. In other words, stay long and stay green. Until next time, everyone.
Hey guys, thanks for checking out the video this week. If you haven't already, please like the video and subscribe to the channel. Every week we're going to be uploading a couple of videos every Saturday of opportunities that you can take advantage of in the markets. Thanks again and have a happy trading week.